Hi guys, welcome back. I'm David and you've tuned in to Let's Go Financial. And boy have I got a good one for you today. It's all to do with real estate. Now, property is something that often becomes the center of our lives. It's a possession that's often coveted, whether it's our home or something that we've leased out in the way of a rental property. Now, as great as properties are, we're living in a period of heightened turmoil. The scene of this world is changing rapidly, and the volatility that we've seen in the financial markets is likely to spill over into the housing sector. We're about to see changes in home affordability that's worth taking a closer look at. Risks not seen before have suddenly appeared, which could affect our ability to service mortgage loans. So what are some of those risks? Should we view property the same way as we have traditionally? Let's have a look at some of the data and see if we can come to a logical conclusion. Now, when it comes to providing insights based on real-world data on the housing market, CoreLogic is one of those groups that can assist. They aim to help you make sound decisions when it comes to property purchases. Now, the trends in the housing market in the United States may be similar to what you can expect to see in parts of Europe and in the Asia-Pacific area. Nevertheless, what happens in America economically affects the economic climate in those other regions and therefore the house prices too. Let's focus on the United States housing market for now. Now, according to CoreLogic, we can see in the last 12 months, house prices in the United States have risen a whopping 19.1%. Now, that's an absolute stellar year, and even in the best of economic climates, it's unlikely that that can be replicated in the following year. According to CoreLogic, they expect property price growth to be only 3.8% in the next 12 months. Now, keep in mind that we're measuring house prices in US dollars. That's our reference point, or our common denominator. I'll talk more about that later and why it's important. Here is a chart that looks at the yearly change in the house price index in percentage terms across the entire United States. Now, the dark line shows the actual home price index change, which is worth considering as we move forward. In 2008, there was a historic systemic risk event take place where prominent financial institutions collapsed, credit seized up, and the entire world entered a recession. You can see how this affected house prices, where effectively for 2 years we saw negative growth. The light blue line shows a decreased growth in property prices that's been forecasted for the next 12 months. You can see here that growth is expected to moderate to about 3.8%. But just ask yourself, has the foundational financial issues of the 2008 crisis really been fixed, or was it just papered over with more money printing? Since 2020, has there been more crisis events added to the mix? Well, I say yes and yes, and we'll talk a little bit more about how this could play out later. I do have grave concerns, though, that this moderation in house price growth could end up looking, at some point, something like this, only magnified if we see another global systemic event take place. For now, though, let's just look at some of the common factors that typically drive house prices in a regular market to get a more rounded picture. We can see the supply of homes for sale in the United States continues to remain low. In fact, from the 2007 and 2008 crisis all the way through to our current period, we can see the amount of homes for sale has decreased by almost a quarter. Now, on the surface, this may appear to buoy up the housing market. However, home affordability continues to be a problem for the average American. Why can we say that? Here is a chart that looks at the home price index in red and compares it to the median household income in the United States over time in black. Now, since the centralized money planners depegged the US dollar from gold in 1971, we can see the growing volatility in house prices over time. The pulling away of house prices from the median household income may indicate that the elastic band has been stretched just a little too far, at least in the short term, and may come closer to long-term norms, back from here to about here, just as it did in the 2008 crisis. This is further emphasised by the personal savings rate of those living in the United States. This chart looks at the personal savings rate as a percentage of people's disposable income. With inflation persisting at levels of around 8%, this leaves considerably less capital to fund things like property purchases. You can see from this chart the growth in the US money supply. In fact, the ongoing levels of money printing that's greater than the growth of the underlying economy is just a masked form of bankruptcy in which default is avoided at the expense of the underlying currency. So whilst here we're talking about rising and falling home prices, we're doing so against a continually depreciating currency, being the US dollar. It's not necessarily the best reference point. When comparing my wealth in real terms, I personally prefer to look at a neutral or appreciating asset like gold, the best of what's out there, rather than something that's inferior. Despite unprecedented money printing from central planners, the amount of money circulating in the economy, as measured by the velocity of money, which you can see in this chart, shows that transactions between individuals is at an all-time low. With less liquidity in the economy, based on what we've seen so far, this does not look great for growth in house prices. If the Federal Reserve raises interest rates a little too quickly to try and get ahead of the current growing inflation rate, which is what we've been hearing so far, then inflation could quickly turn to deflation as the economy contracts rapidly. I'm sure the Fed is conscious of this delicate balance. It seems that the economy is more and more on a knife edge, though, as time goes on. It wouldn't be a stretch to say that we are already in a period of ongoing higher inflation caused by the currency crisis, where confidence in unbacked fiat money continues to deteriorate with low economic growth and higher unemployment. This is called stagflation. On top of all that, if countries like Russia, India and China continue to do business amongst themselves, where a gold-backed currency gradually emerges as a more dominant means of exchange, then it's all over for the US dollar as the reserve currency. Countries all over the world will be forced to follow suit and back their currencies with gold too. Gold will then be the global accepted means of exchange. Here is a chart that looks at the long-term view of the 30-year fixed mortgage rate, where the current rate is sitting at about 4.67%, with adjustable rate mortgages perhaps slightly lower. So as not to crash the housing market, the Fed has been forced to keep interest rates reduced over the long term whilst growing the money supply to levels never seen before in human history. With the recent uptick in interest rates, we are now near the all-time permissible highs. If rates are to rise much higher than where we're currently at, then this could have devastating consequences for the property market as well as the broader economy. That is why I say that the Fed is stuck between a rock and a hard place, where they have limited power to do anything meaningful other than to begin backing the US dollar back to gold to reinstall confidence in the dollar. Ultimately, this would mean a complete overhaul of the current monetary system. I think we should all expect such large structural changes ahead. There are two big factors that would motivate us to either want to buy or sell property in the next 12 months. One is the expected appreciation of property valuations, and two, the rental yield, or the cash flow that we can generate as a percentage of what we've paid for that property. Now, as far as rental yields are concerned, you can see here that yields are typically between 2 and 4%, depending upon where that property is. But with interest rates at about 4.6% and property prices expected to grow by about 3.8% in the next 12 months or so, with a systemic risk event over our heads, how attractive does the property market now look to you? Well, obviously, it will depend upon the size of your mortgage and your general financial situation. But before you answer, be sure to budget for the ongoing costs of running that property. Things like maintenance costs, body corporate fees, yearly property rates and taxes, and insurances. Indeed, property is something that we all flock to. But the question is, at what cost? When a project could cost more to fund than what we can reasonably expect to get back, then issues could arise. With inflation, deflation, even stagflation as real possibilities, one needs to consider such costs. On top of all that, we have a global currency crisis, which makes navigating such turmoil even more difficult. It may be time to lock in a fixed rate mortgage to help smooth out some of that risk. Or perhaps we just need to change our reference point as to what will best help us grow our wealth sustainably over time. Eventually, things will go back to normal, but I can't see that happening until after the global financial reset. Until then, some healthy planning to help better weather the storm may be just the ticket. After all, investing should be something that's enjoyable. It should complement our life for the better. Anyway, Stick with it. See this as an opportunity that builds character, one that you can look back on in time and be proud of. Thanks so much for watching. I'll see you on the next one.